Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings monthly conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star 0. I would now like to turn the meeting over to Nick Hamilton. Please go ahead, Mr. Hamilton.
Hi, everyone. Welcome to our regular update on the Barometer Readings monthly conference call. Joining me today in our offices in Toronto, as always, is David Burrows, our President, Chief Investment Strategist, Sarah Petoskey, Andrea Rybakovich, and I'm delighted to introduce Patrick Reed, who's going to be joining our sales team and representing us in the West. I'm very much looking forward to introducing him to you over the next short while. So since our last call in January 21st, we are at a very interesting inflection point for the markets. That's something that we're going to spend some time on elaborating today. It's always interesting to articulate our process in action and to provide some readings on our breadth models. And that's what we're going to spend some time doing today. It's important to highlight, obviously, based on these readings, we've been spending a lot of time playing defense across the portfolios in January, and we saw some really low volatility and protected clients exceptionally well. What I'll do at this point is turn the call over to Dave, and he's going to highlight where we are today and what we're seeing on the breadth model side moving forward. Dave?
Great. Thanks, folks, for tuning in today. Certainly lots of things to think about in the market over the last couple of months, and no shortage of things for clients to read about in the newspaper. It's always a challenging time when all of the most obvious things are in everybody's faces, and it gives great cause for concern. And these are the times when I'm thankful for having a process that tries to take some of that stuff out. Just to set the stage, as a reminder, we have had a view that we entered a secular multi-year bull market when in the end of 2012 we exceeded the 2000 highs in the S&P 500. And so after 12 years or 12 and a half years of secular bear market, we started to see multiple expansion, and we started to see expansion in breadth. We started to see falling correlations, and there was some structural shifts taking place in the market. We spent lots of time talking about our view that the boom in energy production in the U.S. has been a game changer, and could be the driver for outperformance in developed market equities over the next number of years. So from 2013 through early 2015, markets were very consistent, very few pullbacks. What had been underperforming leading up to that point was emerging markets and commodity producers and emerging market geographic regions. And in the spring of last year, we know that China really started to weaken. Some of the European countries started to weaken, and we had a correction going through the summer. And in that period, we had to play quite a lot of defense, and fortunately, didn't have a lot of volatility. I think the overriding concern middle and late last year was, with China slowing, how is it going to be possible for the U.S. to actually raise rates? That posed a real headwind for yield-driven securities, of course, because if rates were going to rise, concerns were how fast and how much impact could that have on fixed income and dividend payers. And we know that in the universe of securities last year, really the toughest neighborhood to be in was income, and it made it tough. However, markets rallied through the fall and into December, and in December we saw on the breadth models that we follow, globally, breadth started to contract again. When we do our presentation, we spend a lot of time talking about how a correction unfolds. And we, have repeated almost ad nauseum that at the beginning of a decline, you have the weaklings sell off first, or the things that are closest to the epicenter of whatever the perceived problem is. And as a sell-off picks up steam, it'll impact a broader and broader list of securities until late in the decline, stuff's getting hurt that has actually very little to do with the problem. And that's when you're getting late in the decline. So in December, we saw breadth globally start to weaken. And there was lots of things that people were concerned about: China, ISIS, emerging markets, really weak energy prices, which was leading to some concerns around credit in energy. And breadth models started to back off. Late in December, we saw breadth models for the U.S. start to weaken. Now, the U.S. had outperformed the rest of the world for the previous 2 years, as had the U.S. dollar. But in the middle of December, we saw weakness in some of the leading groups, like consumer. Disney took quite a hit one day. The biotech stocks had sold off in November. We started to see some weakness even in the FANG stocks that were so celebrated. So these were the last things standing. And through January, we really saw selling whip through the market. And so fortunately, in December, we were able to put some hedges on in the pools and the funds that we manage, index hedges to mitigate equity risk. As individual positions sold off and broke our stops, we wound up taking individual positions to cash. A lot of stocks held up. A lot of stocks didn't. And, we were pleased that in the first 20 days of the month, when the TSX and the S&P were down 10 and 11%, the portfolios were down a fraction of that. However, as that all has taken place, there's been just a tremendous amount of commentary and speculation and postulation about what may be causing the problem and what it could turn into. We know that, a lot of experts talked about the U.S. and potentially going into a bear market. And over the last couple of weeks, we've done quite a number of meetings and highlighted the fact, you wonder what planet these people are on, because when you look at what's happened since April of last year when this all began, I talk about the epicenter of the problem. Well, the epicenter of the problem is two things. One is energy, and the second is China. So you take all the world markets, the worst performing market from April of last year until January 20th was Dubai, down 45%. That's a pretty bad bear market. China down 41%. Brazil down 36%. Portugal down 34%. Qatar down 32%. And so on down the list. Canada in there fits in down 23% at the worst point. And if you go all the way to the bottom of the list globally, you find the U.S., which ultimately wound up down about 10%. And I think to the lows, maybe 11.5%. So if trouble starts with the weaklings closest to the middle, or the epicenter, and at the end gets the leaders, the things furthest away from the problem, clearly the U.S. has been the furthest thing from the problem. And this has been a focus for us. The U.S. has been really the geography we've been focused on over the last couple of years. So as opposed to trying to untangle all the spaghetti and figure out which economic factor is causing this and when it's going to change, we like to use the breadth models that we follow to look for changing behavior and look for historical relevance and precedence. As you know, we've got a global breadth model that goes back 60 years, and in every meeting we've ever done, we talk about how if breadth, or the percentage of stocks in long-term uptrends, falls below 30% and then subsequently reverses up, you have to assume that you're at a near-term bottom. So that's happened about 23 times in 60 years. And as we went through January, globally, breadth got to 26%. In the U.S., NYSE, breadth fell to a low of 20% about 10 days ago. So I want to put that in context. The last time breadth got that low was October of 2011, at the height of the European Union crisis. And before that, it was in March of 2009. So 2016, 2011, 5 years earlier, 2009, 2 years before that. If I took the lens back further and took the period from 1997 to 2016, 20 years, there have been 5 occurrences or corrections where breadth got to 30% or below. What's just happened, the European debt crisis in 2011, the financial crisis 2008-9, the technology crash 2001 and 2, and the Asian currency crisis in 1998, 5 times. And you've all heard me say that when breadth gets down at these levels and reverses up, it's time to sort of bang the table and put the pedal down. Part of our job is to play defense when people don't want to. And at the beginning of a problem, usually there's lots of optimism and over leverage. And at bottoms, you get tons of pessimism and 50 reasons why it'd be nuts to do anything. So as of last week, breadth in the NYSE turned higher. Since then, breadth in Europe, breadth in Latin America, breadth in Asia, all have turned higher. So now let's look at some background data. As of February the 10th, short interest in the NYSE hit the highest point since 2008, where it hit the same point at the worst point of the banking crisis. So the number of short sellers in the NYSE matched the worst point in 2008. Again, that's not optimism, that's incredible pessimism. When you look at the percentage of U.S. individual investors with a bullish outlook, as measured by the AAII bullish sentiment readings. As of January the 14th, bullish sentiment in the NYSE in the U.S. was at 17.9%. The only previous time that there were so few bulls was for a second after the crash in 1987. Didn't come close to that in 2008. So there's incredible bearishness in this market. Breadth got extended to lows not seen since 2011 and seen only once every few years. We know in the decade of the 1980s there were 4 occasions where it got to below 30%. All 4 were multi-year entry points. And here we are again. So let's talk about the likelihood of a bear market. 90% of bear markets are driven by a recession. Cornerstone Macro has a model that they use where they take 11 markers or things that point to the likelihood of a recession, and they measure how many of those are triggered at any given time. And in a chart that I have going back to the 1960s, there have been 8 recessions since 1960. In each of the cases, at least 50% of these markers were triggering at the time you were getting close to recession, and in many cases 80 to 90% of them. Right now, 1 of 11 is triggering. So no sign of recession anytime soon, and that's been mimicked by the central bank in the U.S. If you look at what the market is telling us about the risk of a banking crisis, the credit default swaps on U.S. and European banks as of the end of last week cost about 130 basis points. So you could insure against the risk of default on a bank-issued bond for about 130 basis points in aggregate. In 2008, that was 350 basis points, almost 3 times as expensive. 2011. And in 2008, over 400 basis points. So yes, credit spreads have widened a little bit, but they pale in the magnitude of what we saw in 2008, 2011. So there is tremendous bearishness in this market. Our work has turned positive. We have a lot of supporting factors that support that. Percentage of stocks with positive weekly price momentum has gone from 8% to 60% in the last week. When momentum turns positive, it tends to be for many weeks at a time. So our stance is changing. Now, if the big concern has been oil and emerging markets, one of the big concerns over the last 18 months has been the real strength in the U.S. dollar versus world currencies. And a lot of people point to the fact that the strong dollar put pressure on S&P 500 earnings. Well, the dollar today is lower than where it was a year ago, and in our work is showing some weakness. So if the U.S. dollar were to weaken, that would be helpful, take the pressure off commodity prices, take the pressure off emerging market debt, take the pressure off S&P 500 earnings, and that could help take the pressure fundamentally off the market. As it stands, the portfolios today look really quite differently than they did 10 days ago. As we've said before, we don't jump in with both feet. We start with partial positions. We look for the emergence of leadership. And I would say from a sector perspective, there's three distinct buckets we're focused in. First of all, the leadership going into the last part of the correction, consumer and technology, have reversed on our breadth models and are showing good leadership coming out. Several of the consumer discretionary sectors, like apparel, restaurants, travel and leisure, are showing strength. Second group of stocks. The group of stocks that behaved poorly last year that are particularly important to the income portfolio, dividend payers. Both bond proxies like telcos and utilities, and dividend growth securities, as referenced by, say, consumer staples, are performing very well. Both held up well through the decline, but are also outperforming in this bounce over the last few days on the back of a strengthening bond market. The third camp is probably the most controversial, and those are the sectors that have been most sold out over the last 24 months, and that would include energy and basic materials, and they are having a bounce. Now, early days of a rally can be confusing because there's short covering, there's real buying, and I think it's too early to say whether the buying in commodities and energy will last or whether they're just a bounce in a down market. As it is, we always start with a partial position when we see breadth improve, and we'll look to add if it were to follow through. And it's not for us to guess as to whether that may happen or not. We'll see that unfold as it is. We have some cash in the portfolios, not a lot. In the income portfolio, we have bought some corporate credits to take advantage of the widened spreads. So as it sits, the income portfolios have about 20% in cash and government debt, about 14% in corporate debt. And then the balance is across the sectors that I just spoke about. The exposure is about 80% U.S. securities, but because the Canadian dollar was as sold out as it was, we're staying hedged on the Canadian currency because there is a risk the Canadian dollar has a bounce. We don't want to get hurt with the U.S. securities. So what cut one way last year, being hedged back to Canadian dollars, is helping us this year. In the equity portfolios, we are more focused on the equity side than in the income portfolios. And again, we're rebuilding positions as they stand. Of course, there's no hedges in the portfolios. So I think that we're in a very good spot. Dividend growth-oriented securities are behaving exceedingly well. We're seeing lots of targets. And when I go back to historical precedents, I think it's really important to look at what you should expect in the early days of a secular bull market. So we came out of the bear market in 2012. We went through a big rounded top in the market between April and February of this year, 7 months. Market pulled back 11%. Let's look at the beginning of the last secular bull market that we know of, and that is when the market came out of the period trading sideways from 1966 to 81. And when the market broke out in 1981, it rallied for 2 years sharply, and then ran into a correction in 1983. In 7 months, the S&P 500 pulled back 11%. Very similar to the magnitude and time period we've just been through. In that 7 months, there was a chorus of strategists who said, oh my gosh, we're going back into that tough market we thought we'd gotten out of. And almost on cue, as breadth got sold out to well below 30%, it turned higher, and the market in the next 2 years rallied 150%. And the reason it rallied so much is because people were so underinvested that they had to chase it the whole way along. Of course, that set up the rest of the bull market that went on until 1999 with interruptions. If you go back to the beginning of the secular bull market that started in 1951, after the market chopping sideways from 1929 to 1951. In 1953, 2.5 years into that rally, the market pulled back 9% over 7 months. And almost similarly, on cue, market turned and rallied for the next 2 years over 100%. It's really easy to make a bearish case when the past has been difficult. And I think it's interesting when we look at the commentary around cash levels, asset allocation is very, very cautious in the market. I can't tell you how many managers I talk to today who tell me they have 30, 40, 50, 60% of their portfolios sitting in cash. And that's just a factor of a reference to the fact that we've been through a number of very difficult years and people are very concerned about getting caught offside again. If I compare that to the attitude that I ran into in 2001 and 2, when we said we thought the secular bull market of the 80s and 90s was done, the common view was, don't worry about it, it's going to be fine, we're just buy and hold investors, it's all going to come back. So things swing to extremes, and it strikes us that the market right now is very emotional, and this is one of those opportunities where we can take a contrarian view and get good entry points with very good risk reward. I know last year wasn't a fun year for anybody, wasn't fun for us, but you have to deal with the market as it is handed to you, and I think that the opportunity that we have sitting in front of us is very, very good, and I've seldom seen, I think, a better entry point. So we're going to watch very closely over the next few weeks as this unfolds. We're going to look for signs of clear leadership. We're encouraged by the fact that consumer and technology are behaving well. We're also very encouraged by the fact that dividend-paying stocks are performing as well as they are. The earnings yield on the average company in the S&P is trading at almost 3 standard deviations over what you can get in a treasury bond. It means we're getting paid well to take risk, and that's when we're supposed to make investments. So with that, maybe we can open it up to questions. Nick will send out a chart pack with the charts that I referenced in the call today, and if you don't receive them, please let us know, and we'll make sure that we send them out. Also, for what it's worth, if anybody there is using Twitter at all, we have a Twitter feed at Barometer CA, and some of these charts have been sent out. We'll continue to send out pieces regularly.
Yep, great. Thank you, Dave. So before we get to questions, just summarize a few things. I mean, obviously, as you know, our commitment with working with you, financial advisors, is one where we really promote the tight-natured relationships we have with you. More information, I think that this type of call and the discussions and meetings we can have right now to articulate where equity market breadth is and the opportunity to gain some context for your clients. Now would be especially a good time to get connected to review these readings and review these charts that we'll have out to you in short order and talk about the opportunity that we have only seen 5 times in the last 20 years here. So the good news is folks here at Barometer, we've taken our responsibilities very seriously to provide defense into really difficult months like January. Our income portfolio was down 0.1%. That's the income pool for January. The income fund was down 0.4%. To the end of January, we even had strategies like Global Macro Pool that was positive through a very, very difficult period. But now, as we've seen a reversal in breadth models, we're playing less defense, and we think it's the right thing to do. So with that, at this point, we'll open it up to questions.